Welcome to the Property Couch, where each week you get to listen to two of Australia's leading property experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle Channel, and Ben Kingsley, Chair of Property Investment Professionals of Australia, and the 2014 and 2015 Property Investment Advisor of the Year.
All right, folks, you're on the Property Couch, where each week Ben and I give you the insider's guide to property investing. Mate, it's always good to be in Melbourne in September, isn't it?
It is, although we've got a week to wait for finals, haven't we?
I'll buy.
You know what I'm looking for? I'm just looking for the trade talk now and who we're going to, basically recontract, who's out of contract. So that's the only thing I can focus on.
Yeah, it's only because everyone wants to come to Collingwood that you like the trade talk the most.
Have we got anything? Is Jake O'Meara coming to us? Is he going to?
You probably.
Jager O'Meara.
Jager O'Meara. You'll probably get them all. Yeah, you'll get.
Here we go.
You'll flog Cloak over to Western Bulldogs, and then you'll pick up some gun again.
Well, they're talking about him going second or third round.
Yeah.
He's an All-Australian. He's taken the more contested marks in the game than any other footballer.
So what have you done
in the
to
last 5 years?
What has your team done to him?
Oh, we've just got high expectations. And,
Very good.
It's very hard to play for Collingwood. Everyone has high expectations when you're the biggest club in the land.
So are you still going for Sydney? Remember you declared a couple of weeks ago you're going for Sydney?
Yeah, I want Sydney to win the premiership. Yeah. And I'm making a call now. Look, Hawthorn are a great side, right? But I don't think they've been in spectacular form this year. They've got over the line because of their skill and their brilliance and their experience.
Besides that, they're nothing.
Well, but if the finals take it to the next 5%, don't they?
Yeah.
So you've got to wonder whether they've got enough to do that. I mean, and to do 4 in a row, there's only one other club that's ever done that in VFL, AFL history, and that was the Machine, which was the Collingwood team of 1929, 30, 31, 32.
Can of worms here,
right,
mate.
yeah.
That's VFL. That's old time.
I walked you into that. I didn't know.
Old time. Come on, Adelaide. You can do it from fifth again.
No.
Mate, auctions last weekend. There was over 1,000 auctions in Melbourne for the first time in eons. And we as a team lined up for 8.
Yes, we did.
We got 3.
We're 9. I did 1 as well.
That's right.
9,
yeah.
We got 4.
Yours don't count, do they? So we got 4 out of 9. And so less than 50%. So that's the even professional buyers don't buy everything, Ben, is the message. But what a welcome relief it was to see a bit of extra stock, I've got to say.
Yeah, that's true.
Because some crazy stuff's happened over winter.
There it is. I did an interview with the Financial Review this week. I don't know when the article will come out, but we were talking about that. There's a real, inside the market at the moment, there is a real shortage of existing properties coming up for sale in the 3 and 4 bedroom space within effectively 20 kilometres of the 2 major cities and maybe 15 kilometres for Brisbane and maybe 10 kilometres for Adelaide. And that's the stuff that we love. Yet there's plenty of off-the-plan high-rise stuff that's coming online. So people are talking about an oversupply, and here I am talking about an undersupply of this quality stock, and it's becoming very hard to pick up.
Which is good news for some of our clients who are listening to this, because they hold very good quality 3 and 4 bedroom assets close to the majors. Hey, I went to an auction in Yarraville on Saturday, 650 plus quote range, went for 850. I wasn't the underbidder, I was 4th in line. So underquoting is one of those funny ones, isn't it? But it's interesting for the listeners. We had a very, very prominent Melbourne agent in the office 2 Mondays ago. Writes over $2 million in gross commission income.
Wow.
And just for the benefit of the listeners, that's very rare. Most people don't hit 1 million, so to get 2. And we asked him the question about underquoting.
Yep.
And he just says, we don't have the conversation about price until the day of the auction. Because, and this guy's a really good guy. I'm not going to name him, but he's a really good guy and he's a really good operator. But he said, I don't want to have that conversation with the vendor until the last minute, so then I don't get in trouble with underquoting. Because he goes, in the current market, I can't control what the buyers are going to do on the day.
Yep.
And he goes, and an interesting point he made is the buyers who are generally buying, they know the price anyway. So it's probably a good point for the rookies or the people who are just getting into the game soon, that even the buyers who've been around for a little while, they know where real value is. So it's important that you make sure you know where real value is.
Yeah, and if we fly around the country, we also know that in Queensland, you're not allowed to quote a range. It's just crazy up there. Sydney, I think, hasn't got a bad one where they're doing some comps, and we just saw legislation go into Parliament in Victoria about this underquoting issue, where they're going to have to give some comparable sales. and they're going to have to document those comparable sales at the open, so they can set the expectation of the buyer. Because it is very frustrating for that inexperienced owner-occupier or that inexperienced investor who thinks they're in the market, and they go and spend $400 or $500 on building and pest inspections, and they get smashed. Yeah. I was at an auction again in the inner west, and I think I was third in line for who eventually bought it. So I thought, we thought we'd comped it beautifully. We put a little bit of a stretch in there given the conditions of the market, and it still went over that. And it was a young couple. So this one was a doer-upper. So from that point of view, the young couple were willing to pay a premium to get in there because their time wasn't going to be charged out professionally. He looked like a tradie. So he was going to get in there and tidy it up as their first home. So good luck to them. Yeah. But from our investors' point of view, we saw value at that lower range. It went above that, so we move on to the next one.
Yeah, very good. And what you just said before too is people should still get a building inspection even if they keep missing out, because if they're up to third and fourth, they might be thinking, I've burnt now close to $2,000, but $2,000 collectively is still cheaper than major footings issues. It's going to cost you $100,000. So stay in there. I've been talking to the team here about reminding the clients that we've got to take a bit of a telescope view rather than the microscope view. Yeah. Because as soon as we talk about money, everyone's sort of anxiety kicks in. Their breath is a little shallower. But we've always got to remind them what the bigger picture is here. When it's not brain surgery, it's just buying a property, even though it makes a huge impact on someone's life, that we've got to still do the basic fundamentals. So even if you've been to 3 or 4 auctions and you've had to get a building inspection, don't be tempted to skimp on the next one, because you could get a very expensive mistake, and it's very tempting.
It is. Well, what about Nicole's story? So, she gets the building and pest done, and they find termites. So obviously we pull out, because even though the termites were in a small, isolated, we didn't know it was isolated. We couldn't get under the floor in terms of have a look. They could have been in the roof. They could have been everywhere, but we just found one pocket of live termites in this particular property. So we pull out. The property goes for an absolute bomb. And the buyer probably doesn't even realise they've got termites. Yeah. So, if they haven't done that, because I would have thought there would have been less interest because of the uncertainty. Now, that could be a $20,000, $30,000, $40,000 fix. It could go really high. It could be a $3,000 fix. But even the pest inspector's like, I've got no idea until I'm ripping the floorboards up and I see just basically, how much dampness is in here and where all their trails lead. And if they're up in the roof, they could be a massive nest in the roof. And then you're up for tens of thousands. So that's the interesting part.
So bricks and mortar bank account, folks. Don't be tempted to throw any emotion into it. If there's any doubt, you better to err on the side of caution.
Now, there was one other auction I went to on the weekend, and this is for all of those inexperienced listeners. And this is a good little story. So the property was passed into me, Bryce, at $750. Okay. Now, the agent did the right thing by basically asking everyone, if I've got no further bids, I'm going to pass the property in. I'll have to pass the property in. No further bids. Okay, ladies and gentlemen, I'll pass the property in. And here's $755 coming from the back. And this girl's on the phone and she's gone, I'm putting a bid in. And he goes, I've just passed the property in.
Which bit didn't you understand?
Which part of that didn't you understand? Now, there's probably a crowd of maybe, 30, 40 people at this auction.
And that's just because they knew you were there.
No, not true. and so I've got the first right to negotiate. And so I'm obviously in that process, and she's out the front having an argument because she's getting this advice from her so-called financial planner over the phone. Yeah. So it's a classic case of the financial planner not knowing the rules. Yeah. And everyone sort of thinks that, it's the best strategy is to come in at the very end, to try it. And so she's thinking, I'm just listening to what you say. So you can imagine the embarrassment on him. So he's like, get me on the phone. I want to talk to this, this selling agent. Yeah. And long and the short of it is, we got the property, okay, and we got the property for less than she was prepared to pay. But legally, the agent had to abide by the rules of auctions, and that is that we need to explore every avenue with the property that's passed in. No one else can basically put offers in. So it can't turn into this silent auction. So it's another great example of certainly knowing what you're doing and getting professional advice in some cases.
Yeah, you don't want to be too early, but you don't want to be too late. No, that's right. That's probably the theory of that story. Hey, we've got some Q&A that we want to crack into, Ben.
Beautiful.
So there's some good ones here from Jesse. Hi guys, I've been listening to the podcast for about 6 months and it's been a great source of education and illumination for me in all things property. Thank you and keep up the good work. My question is regarding the current development boom that has exploded all over Melbourne as it relates to my property in Bayside, Melbourne. My wife and I bought a townhouse in Cheltenham about 8 years ago. So that was 2008, around the GFC. It is on a reasonably busy road that goes from Nepean Highway down to the beach in Sandringham. We've been diligently paying it off as quickly as we can in order to give ourselves some freedom. In brackets, we are both freelance. And now we are looking to buy our first investment property. This week, the house next to us and the next 7 houses along have all got for sale signs up in front. Our understanding after a brief chat with the next door neighbours is that they have all been approached by a developer who wants to build a large mid-level apartment block right next to our house. Our concern is what impact will this have on our property value. We are now planning to move out and rent vest as we don't want to stay there through this construction phase. Our main concerns are A, how this will impact the value of our property when it comes to us getting a loan for an investment property, and B, the impact this will have on our ability to rent out our townhouse if this development goes ahead. In light of this, are we better off trying to sell now and cut our losses or stick with it as a rental? Kind regards, Jesse.
Wow, Jesse.
Wow.
That's thank you for sharing, because this is really important for all our listeners. So there's a few things few moving parts. Now, I can't comment specifically on your personal situation until we did a full review of the whole project and what's happening. There's a couple of things that I do want to highlight. The number of bedrooms that you have in your townhouse is going to be pretty significant compared to potentially the type of accommodation that's going to be built next door. So in other words, if they're going to be building 1 and 2 bedroom apartments in medium density and you've got a 3 or a 4 bedroom townhouse or a duplex and you've got a backyard and you're on your own title, well then it's not going to have as significant an impact as what's going to be built next door. So for me, this is always the slight risk of building on a sort of a medium or high density road. So sort of an arterial type road. They are always the risks of those roads being rezoned, because that's the easiest way in which council can get some medium density or high density into their suburbs.
Particularly next to a transport node, like
Correct.
a train station.
Well and truly. So again, it's going to come down to case by case for this. But for me, if it is a freestanding house or a townhouse that's got a common wall and you've got that space, I don't think it's going to be as bad a story as what it may play out to be in your mind, because your accommodation is going to be different than what they're potentially going to be offering next door. So, and it's got a different audience. So people who will want to rent your property out will probably be families who want to have the swings in the backyard, and that's a good story. The challenge here is if they are considering doing, say, a block of townhouses along the front, 3 and 4 bedrooms, and then putting some higher density in behind it, well, that's potentially going to be a challenge, isn't it, Bryce?
It is, and so there's a couple of things. One, no one wants to live next door to a big construction site, but
No.
if you've talked about rent vesting, so if you are prepared to go and find somewhere else that you want to live in and rent it out, you just have to have the rental market that accommodates that, and water will find its own level on that. But I would suggest that you play the long game. You've mentioned here, so from what we know, you've been diligently paying it off. It's your principal place of residence. Ben and I always have the conversation around client. We rarely recommend anyone sells a property flippantly, Ben, even
Correct.
if it's a dog, because it was 6% to get in. You've spent some money on interest throughout the year. It's 2.5% to get out, and then it's 6% to get on the next one. So your break even on your next purchase is 20-odd%.
Over 20%.
So if you're playing the long game here, Melbourne is going to get an extraordinary amount of population growth. So holding this asset long, you're in Bayside, so you're some of the most desirable parts of Melbourne.
Absolutely.
So the long game is fine. So really for me, this is just a question of the inconvenience of during construction phase. Because if you're in a in a low socioeconomic area and something like this happen, the different conversation.
Absolutely.
But Sandringham is highly desirable. It's got some amazing schools down there in that area. You're near the bay. In summer, it's amazing. So I'd just say to you, the big part, will this have an impact on our ability to rent out as a townhouse? It will during construction, no doubt. But when that construction's over and the supply is taken up because you're in a desirable area, it'll, again, water will find its own level. So in light of this, are we better trying to sell now and cut our losses or stick with it as a rental? If you try and sell now, it's no secret. The person who's about to buy it knows that there's 7 houses with a for sale sign. They're gonna have so it's not as if you're going to get a premium price, or probably not even equilibrium. You're probably going to have to give a discount. So my view is if your cash flow allows, and I don't know that from here, play the long game, go and rent vest and maybe buy another investment property and you should be fine.
Yeah, keep an eye on what they're proposing. I mean, if they're going to overdo it in regards to they're going to try and put so much stock on there that it's going to go to VCAT, obviously you'll appeal that and you'll fight hard to try and keep it within reasonable quantities and appropriateness for the area. So that's what we always talk about. In our local communities, we're always adverse against inappropriate development. So if it's inappropriate for the area, you can fight that case. But once if it does still get up through VCAT, where they get an approval that's an exemption, then once all the sold signs are gone down and there's no noise, it still might be 18 months before they get it off the ground, especially if the marketplace is softening. So that could be your window if you're thinking, and some people who don't do their due diligence and don't work out that there's going to be a big construction built next to them, because again, it's KVDM talk, buyer beware.
Absolutely.
So that's an important one. But there was another question you asked there, Jess, around does it affect your borrowing and going to the banks? The reality of that is it shouldn't at this moment in time. The valuer may be a little bit conservative, call it 2%, 3%, but in terms of releasing equity, the bank still says, well, wait a minute, this is your freestanding or strata title townhouse. So from that point of view, you still want to go there, you still want to release the equity, and you still want to do more with that. So don't be afraid that the banks are going to sit there and say we're not going to lend against it because you've got something being built next to you. People have renovations happening on next door all the time.
You're not in Moranbah.
No, exactly. You're not in a ghost town.
You're in Sandringham. So
very good. Okay, next question comes from Sonia. Hi, Bryce and Ben. I'm a big fan. I've been listening to every single episode of The Property Couch. I have a few investment properties in the Sydney inner city suburbs. Good on you. Yeah. Besides that, I also have a decent amount of savings in cash. Good on you. I just quit my job to study interior design, hoping to set up my own business later on. I'm the typical rich in assets and poor in cash flow example. Just wondering, what is your investment advice to people like me? Thank you, Sonia.
Great question, Sonia. Still lots of unanswered questions on that, so we're going to have to make a whole heap of assumptions. But it's interesting, I had someone on the show, Ben, who rang me this week, who's not too dissimilar to that. So asset rich, she has a house in the eastern suburb, an Art Deco apartment in the eastern suburbs of Sydney, fully paid off, fully renovated, but that's it. And hasn't worked for the last 5 years. And so I said there's the three C's, the character, the collateral and the capacity. You've got to satisfy those when you want to build a portfolio. So her character was fine, but the bank would sort of say, well, you haven't had a job for 5 years. That's going to be a challenge in terms of your capacity, because if I have a job and I can provide pay slips, that's no problem. But in the case of Sonia, she's left a job to go and do something that is it looks like the early stages of the business plan for the interior design business. So any bank's going to say, what is your income and how are you going to demonstrate the ability to lend more, to borrow more money? So I would say the advice to Sonia was probably we would like to have had a conversation prior to making that decision, because we need to get the lending sorted and in place whilst you're in a position of strength, not in a position of weakness. And the weakness is from the perspective of lending. Because she said she's got lots of cash, she said she's got a number of investment properties, we don't have much equities in it, but generally speaking, to leverage into more, if that's what the plan would need, to leverage into more lending would require her to demonstrate an income. So I think that's going to be the biggest challenge that Sonia faces, is the capacity.
I agree, Bryce. This is a planning and cash flow story. So if you've done a business plan around what you're going to be earning from an interior design point of view, and we also know what's your fallback. I mean, you've been confident enough to quit your job. You must be very good at your job because you're quite successful in terms of the wealth you've been able to build and the savings you've got. So obviously your fallback is I'm pretty confident that if this doesn't work out for me, I can potentially go back into the career that I was successful in and earn a fairly good income. You know, again, I'm making an assumption there. So for me, it's almost like, okay, well, and like I do with every client, it's all about cash flow story. So what's going to be happening to those cash flows moving forward? What is the anticipated income that I'm going to earn as a interior designer? And then I'd probably take 25% off that. And then I'd look at the story around how much cash, how long you're going to preserve that before it's all taken away to try and work out what the next move is. But I support you, Bryce, in terms of how we look at it. People often talk about property as being illiquid. It's basically being, you know, the money's not there, but we make it liquid when we get the equity out and we put it into an offset account or we get a line of credit facility. So that just buys us time. The art of investing in property is all around cash flow management and asset selection and borrowing, you know, and obviously putting that defence in the good old ABCD. We've talked about it plenty of times before, and this is a case for that. So how would I move forward? Well, it's going to depend on how successful your interior design career is going to be. And as we know more confidence around that, then we can have more confidence about, you know, taking that next step. And that's also, you know, if you've got some debt against those inner city properties, you may not need any more. You may just be able to pay it down and live off the passive income from the portfolio you've already built. Because if those inner city suburbs are like where we think they are, you're on gold mine. So it's potentially a time story.
Cracking point, Ben, because that's the footnote to the story when I chatted to this person during the week.
Oh, yeah.
$1 million unencumbered, could rent it out for $900 a week. So what's that, $45,000 a year?
Yep.
So my suggestion to her was, if you can live your life on $45,000 a year, because she likes to travel overseas, where you don't need a car, you don't need to maintain a house, you can, you know, just go to a place where it's cheaper to live. That might be enough. We always talk about $100,000 passive income, but she's got a $45,000 passive income that comes from the investment property. So Sonia, if those investment properties don't have any debt already, and you may be in a position where you don't need to do anything more. So again, we're making a whole bunch of assumptions, but the big picture here is it's all, if you want to leverage further and move forward, it's all about income. And, you know, the bank's going to ask for some tax returns. Yeah,
so it's just, for me, the summary is, as you talked about it before, people think because they've just got equity, they can borrow money. Banks need you to repay it. So
that
servicing,
was the 80s. That was the 80s. Ask Alan Bond.
That was low doc, no docs. That was the 90s as well. So just because you've got equity doesn't mean the banks are going to lend you any money. There's the equity and the servicing side of it. So, you know, you've got to have that income because the bank's saying this is a 25 or 30-year loan. What are you going to do to bring the money back in to pay the debt off eventually? So that's part of that story, Sonia. So thank you for the question. I reckon it's a ripper.
Very good. Kai has sent us in a three-part question. One, is it better to pay off the mortgage to keep buying investment properties? That's number one. I wrote an article on that, Ben. It's in the Money magazine. It was conclusive.
Should we post that on the website?
Yeah,
that's I think a great idea.
I don't think that's on the stands anymore. I think we'll be okay to post that. The Money magazine article I wrote. So there was a $2.5 million better off.
There's your answer. And this is
in a certain scenario. So if you go to thepropertycouch.com.au, I was just having a panic.
Because we're highly organised, highly produced show, this one.
Stig said no. So next week, we'll have that next week. There you go, folks. So, Ben, do you want to comment?
Oh, look, there's in over a 20-year period, if there's not $1 million difference in it, I'll go he. Yeah. In other words, it's absolutely better off, rather than paying the principal off the loan, this is pretty much what we're about, instead of paying that $500 principal amount off the loan, what if that $500 could control a $400,000 investment property?
Bingo.
You're getting a return on the $400,000, not on the $500 that you're saving the interest. That is the power of leverage. But you've got to make sure that you can sustain it over the long term, because property is not a speculative investment.
Mate, you're a very, very wise man. Okay, question 2. I've forecasted passive income of $60,000 as a couple in the next 10 years, assuming 5% annual price rise. Good, nice, conservative.
Yeah, conservative.
And if I sell down my 6 properties to fully own 3, including the principal place of residence, how do you increase this to 100? keep buying 3 to 5 more properties in the next 5 years? Question mark.
Well, the question there is what forecasting have you done? Because obviously there's a compounding nature to the value of those properties, and there's also potentially the increase on the rent. So it becomes a pretty sophisticated, and there's the tax benefit. So eventually there's negative gearing, which then turns into the positively geared. I would love to think that they could hold all 6. And don't forget, when you get to a certain age, you're going to have access to a lump sum through super. So all of those things play out perfectly as part of a planning strategy to sort of work out exactly what it will be. And, if one property can sustain you, so let's say you said sell down 3, what if you sold one property and it gave you a net surplus of $80,000? Well, that's the $80,000. You're going to use 60 of that to live for the next 12. So all of a sudden, or it might be, that might push you out to not have to sell that next property for 3 years down the track, which means, well, great, you're getting the capital growth on that. So all of a sudden, it's only 2 properties that you have to sell. So this is where it comes all down to understanding your cash flows, understanding your potential, using all of your assumptions and your forecasting capability through, obviously in our business, we use our simulator software to do that. And that's how we can answer those questions for clients. So, the biggest frustration I have with some people is they sell when they don't need to sell. And also there's capital gains, and so some of them sell in the same year. So why not stage the sale process so you can sell one on the 30th of June and then sell another one on the 2nd of July, and they're in 2 different tax years. So the capital gains, which is income for that year, will be treated differently over those 2 year periods. And it's always best to sell them when you're not working.
Because then you're on the marginal tax rate at a lower amount. You get that funny look. Hey, I just recently purchased a property for a client.
Yep.
In the lead up to 30th of June. It was about the 23rd of June.
Yes. And
it was such a good buy, I jumped on it, right?
Yeah.
And the vendor agreed verbally and then said, however, I'm not prepared to sign a contract until the 1st of July. Because for capital gains tax event, it was important. So what you just said, they got the timing right, because they didn't want to sell to me on the 23rd of June. They wanted to be on the 1st of July so that the capital gains event moved to a next financial year. Now, that's not a very good 7 days for me, Ben, because verbal means nothing. It's got to be in writing. So I've reluctantly sort of, there's nothing I can do.
No, he's not going to change his mind.
Not going to change his mind. So, and I was just going to say, Ben, we always talk about time target, income and expenditure. Yeah. That's kind of a bit of a summary for question 2.
Yeah, it is.
So it just depends on where the priority lies out of time, target, income and expenditure.
Yeah.
Mate, you answered that like a pro.
All right, what do we got next? We've got Adam. G'day, Adam. Hi, guys. I'm loving the podcast after learning about it from a friend. I have a scenario which I'm sure some other listeners will find themselves in. I own a positively geared corner property in North Sunshine in Victoria. I'm ready to take the next step into building my portfolio. Does it make better sense to develop my existing property into 3 townhouses, or to go and buy another investment property, keeping in mind that the property price growth will most likely exceed the building costs? Thanks for your consideration. Adam.
Yeah, good question. I like North Sunshine. I think it's a good place.
Yep.
One of the things that I like about this question is really thinking about the bigger picture, because he's already owns the land.
Yep.
And therefore, if if Adam is confident that he could expertly project manage a build, I think there's an opportunity, because it's really that old-fashioned wholesale equity manufacture.
Yep.
And you're still controlling the land. And then if you can use that as a strategy to own more real estate that gets more income, that'll help you reduce the debt quicker, then you're heading towards nirvana quicker. Because for us, it's not about the chest beating of how many properties I've got. It's how quickly can I get to my passive income goal. And I see that strategy as a very, very quick way for Adam to, because I agree that the growth in Sunshine is looking very positive. and therefore if he controls the land and improves the yield, because you turn one, what did you say, 3? So you're turning 1 into 3 incomes,
which is nirvana on a single site usually.
Oh, absolutely.
And then 4 even better. But
then North Sunshine, you might have a pre-85 building, which means no depreciation on the building.
Yep.
Then all of a sudden he turns it into 3 post-85, so he gets depreciation on the. Geez, Bradbury will be proud.
Yeah. Well, you almost got the scrapping in there.
So the depreciation on the building for 3, as well as the extra income. So I see that as an enormous opportunity for Adam, as long as Adam's comfortable with having no income during construction, can manage the debt, because it gets pretty peak debt during construction, and can hold their nerve right through to the tenanting of that.
Yep.
That's a ripper position to be in.
Because I would love to see him hold on to all of them.
Yeah, I agree.
So, I mean, I'm thinking, okay, I'm land banking. I've got that sitting there. It's got a house on it, so it's producing income. Should I go and just buy another little passive investment? The answer to that is probably not for the moment, because that's going to take up your borrowing power. So I'm with Bryce 100% on this, but Adam, I only want you to do it if you can hold on to all of them, or you have to sell maybe 1 down. If you've got to sell 2 down to make this work, it's not a good outcome. I mean, ultimately, the longer you keep it as a potential development site, it's growing in its appeal anyway, and someone could offer you a ridiculous amount for plans and permits in today or in 5 years' time for it. So it's producing asset. But the moment you can get your finance to line this one up, and you will find that once you get that development finance, you will be able to refinance it to residential, more than likely, depending on the current loan. Because there's 3 of them. So once you work out the rent on all 3 of those, it should be positively geared, I would have thought, once you put the depreciation in there as well. We're assuming, but it doesn't get any better than that. One, you've harvested an enormous amount of equity. The property's taking care of itself. You've got this big depreciation, and so you're ready to go again. So your portfolio will go from 1 to 3 very quickly, and then a 4th one will come straight in behind that once that's all rented out and you've got that cash flow coming in. So
it's turning apples into apple pie, Ben.
You're absolutely right.
It's turning apples into apple pie.
Adam, there you go. Some gold from Bryce once again.
There we go. Hey, can you hear that, Ben? I think
that's Ivis laughing.
No. I think it's a disclaimer coming.
Oh, yeah.
Disclaimer.
Okay.
All of those Q&As, of course.
Yes, of course.
Were a heap of assumptions being made. So we're putting in this is the boring section, the disclaimer that says you have to go and talk to your
important but boring.
So there you go, folks. Don't rely on anything we said, pretty much for 79 episodes. There you go, I've covered it all. So,
and for the next 150, so we
correct.
can always refer back to this one.
So there we go. You should always get specific advice to you guys. Very good. So there we go.
Time flies.
I know. We're ready to.
Bit of auction tips in there early. A bit of market observation, and some Q&A.
Mate, this is our favourite part of the week. 30 minutes crawls up on us very quickly. So,
very true.
All right, a couple of things.
Yep. What do we got?
Facebook Live. I've forgotten the date. September 13th.
13th.
Tuesday, September the 13th at 7:30. If you haven't got a copy of the book, get a copy so that we can run through that with you.
And we're flogging that cheap, is that right?
We are. 30%! 30% off, folks. If you go to the Property Couch, you can get a copy of that.
/book.
/book. FB Live is the code.
Oh, FB Live. So there's a code.
There's a code.
God, we make it hard.
I know.
Why don't we just give it away?
It's 30%. We have got some reviews, Ben. This is a bit self-indulgent, but we're trying to get 200 reviews, aren't we?
Oh, we're greedy.
I know.
We're greedy.
We got some great reviews, but if you're on the train, you're listening to this...
We've got nowhere to go.
It's for the greater good.
Of course it is.
Because it ties into our next goal, which is 1 million downloads.
Yes.
And the way we do that is by asking everyone who listens, who gets value. If everyone's sort of a bit iffy and thinks we're a pair of nut bags and they don't get any value, that's fine. But if someone thinks that there's only one nut bag here, and we'll leave that open, if they could just tell one friend.
Yeah. Well, we've got I told a friend of mine put me on to the pod. I like that. We're getting a few of those in the Q&A.
Just tell one friend. We're not greedy. Just tell one friend.
And what the reviews do, they put it into the what's hot list. Yeah. So if people are new to podcasting and they're new to iTunes, they can be fluffing around there and they can say, so it puts it up in the...
Look how
and
far
that helps
you've
more
come,
people.
Hey?
I know.
Before we did our own podcast, you didn't even know what it was.
No, I'm like, what are you doing?
Now you come to me every morning and say, have you checked this one out? Have you checked this one out? So, mate.
Yeah, I don't watch TV. I don't do anything now. I just listen to podcasts.
It'd be interesting if any of our listeners are the same, because if they're listening to our podcast, they're probably the podcast community.
Yeah.
I'm in no news cycle whatsoever anymore. I don't hear it in the car on the way in. I don't listen. If I've got spare time, I'm either on demand at home or I'm listening to a podcast. So I'm totally out of the loop. So it'd be interesting if anyone's got the same. Let us know on Facebook if you're out of the loop also.
Well, you know the reason why? Because we're so time poor.
Yep.
So for travel, we can't have to have our eyes down and smashing into lampposts and all those type of things. So that's the thing for me. I can be, when I'm walking, when I'm doing whatever I need to do, driving to work, it's just on.
Do you get that panic? On Tuesday, I'm on the runway. I'm about to fly. I'm going to Adelaide, and I've panicked because I haven't downloaded any. Because I'm thinking, when I'm in the air, I can't. So
I'm turn your phone off. So we're going to crash.
So I'm the guy that's quickly put it off flight mode. I'm downloaded a couple before we've taken off, and then I'll quickly put it back on flight mode.
Oh, good. That's why you didn't crash.
At least I had something to listen to on the plane. So there we go. Anything else? We covered everything. Ivis?
All good.
Got everything?
The producer's giving us the nod.
Got the
get off.
Get off.
I need to go and produce this.
Yeah, by 3.
All right. So this is where I kick in.
This is where you kick in, mate.
Okay. So Simba, who shot me an email and basically.
Isn't it the line?
Yeah, well, it was the line in Lion King. Yeah. Do you want to give us a little?
Well,
can you see
I do sing a Wombo way to my 3-year-old quite often.
So anyway, look, no, obviously Simba, if that's offensive to you, we apologise. Yeah. We don't want to offend, but it's a beautiful name.
Yes.
It's a beautiful name. Anyway, so you were kind enough to give us another African language called Shona.
Okay.
Shona. So here I'm, and translate, well,
here we go, folks. You waiting for this?
Musari. I love the way you sort of hyphenated this out for me so I can pronounce it. Musari Mushaha. Musari Mushaha.
Well, seeing as it's hyphenated out, we've got to be impressed.
Oh, that's not bad, is it?
One more.
Translated to stay well now that we are parting. Stay well now that we are. That's beautiful, isn't it? Mate. Stay well now that we are parting. Where's the things that we are parting?
No, thank you, Simba.
That is beautiful.
Yeah.
And that is Shona. I want to learn more about Shona language after that. If it's translated as beautiful as that. Mushari Mushaha.
There we go, folks. Until next week, Mushari Mushaha. You like it? That's good. All right, folks. See you next week.